Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre, and welcome to the 2026 Forest Products Outlook webinar. Before we get started today, I'd like to offer a few technology tips to keep in mind while reviewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be time for questions and answers at the end of the presentation. Questions can be submitted at any point during the presentation using the question mark button on the right side of your screen. This will expand a text box where you can then type in your question. And a recording of today's webinar and presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And a quick disclaimer, this information is presented in good faith and is not intended for investment, tax, or legal advice. A quick reminder that today's webinar has been approved for the continuing education credits shown here. Please email chris.lawton@farmcrediteast.com following the webinar for an attendance certificate. Okay, and today we have Paul Jannke of Forest Economic Advisors joining us to provide an outlook for the forest products industry. Paul has studied and provided insight forecasts for the North American lumber industry for 25 years, making him the industry's top economic analyst. I will now hand it over to Paul.
Thanks, Kelsey.
You should be able to share your screen now.
Got it. Hopefully, let me know when you can see it. You can see it?
Yep, looks good.
Excellent. All right.
Oh, you do have, real quick, sorry, you do have a notification. Looks like you can say hide, and I think it should go away.
Oh, stop this sort of hide right there. Gotcha.
Yep, looks good.
All right, cool. Well, thank you for having me today, and thank you for listening in. I tried to be good and keep 46 slides for 45 minutes, so I'll probably go a little bit fast through some of them. But a lot of this is really here for your background information as well. And then I do have my contact information at the end. If folks have any questions, feel free to reach out to me directly. Yeah, so with that, I guess crazy times. This forecast was done in late February. So when I say late February, it was starting around the 20th of February, so the last third of February. So obviously a few things have changed since then. We have not started our next forecast yet. We'll probably start tomorrow. So we usually start around the 18th or 19th. Oh, by the way, forgot to say, but happy St. Patrick's Day, even though I can't spell March apparently. It is March 17th. So yes, so in any case, I'm not sure how much we're going to change our forecast in the short term. I don't know that we will. For this month, we generally don't like to change our forecasts based on just things that happen in a given month, unless we think that those things could potentially last longer. And I actually have a slide on this a little bit further along, but there's quite a bit of talk now of this war lasting for 3 weeks, potentially shorter. So again, we have no insights into how long it will last, but as of now, we don't have a lot of evidence that indicates that this would be something that would last for an extended period and could affect the markets more than what we have, more than sort of a short-term blip. So, and I think the general markets believe that as well, and I'll show you a slide on that in a minute. So here's our forecast, as I said, as of February. Again, if this war lasts longer, then I think you'll see higher interest rates and probably slower housing starts than what we're forecasting. But I can address all of that in questions, or you can call me directly as well if you want to talk more about it. So to begin with, I just want to talk a little bit about the overall economy, and then I'm going to get down into housing markets in particular, both new construction and R&R, and then I'll get into the demand and supply side of lumber, and then I actually have some pulp slides for us this year as well, pulp and paper slides. So I'll talk a bit about that as well. So the overall economy really is the main driver behind what's happening in the housing markets, and in the pulp and paper markets, so the end use markets for our products. And while GDP growth may not be the main driver for housing starts, GDP growth does impact interest rates and income, and then ultimately home prices as well, all of which affect affordability. So it does impact housing starts through there. So what this graph shows you is GDP growth in the bars, and then the core GDP growth in the red line, and that's just your final sales to domestic purchasers without government spending. So that takes out trade and inventory change, which tend to be really volatile. So it really looks more at the core consumption and of consumers, of household consumption, and inventory spending as well. Those core drivers behind growth, and taking out some of the more volatile components of it. So what you can see here is that, yes, we have a lot of volatility. We had, Q4 was weak. This is the revised Q4 numbers, which were 0.7% growth, down from about 1.4. So you can see really weak growth in the fourth quarter. You saw weak growth in the first quarter of 25 as well. But if you look at core GDP growth, it's really been quite a bit more stable, sticking right around the 2.5% to 3% range. And so that's that core consumer and investment spending. If we look at the Fed's GDP Now estimate, which historically has been a really good estimator of where GDP is going to be in the current quarter, so that would be Q1 of 26, they're predicting about 2.7%. So the Fed's GDP right now has growth bouncing back. Why is that? Well, first off, the GDP Now indicators, it just takes in all of the various indicators that are out there that the Fed puts into its model, and every day new indicators come out, they plug them into their model, and that gives you a really up-to-date estimate of where the economy should be based on historical relationships between GDP and those various indicators. So it has been a pretty good predictor of GDP growth in the past, for the current quarter, and they see it bouncing back. So why is that? Well, the indicators that are out there, but in addition, a lot of the weakness in the fourth quarter really had to do with trade, declines in trade, declines in government spending, and actually an increase in imports as well. So an increase in imports impacts GDP growth negatively. So if things are being imported, they're not being produced here. So that's a negative on the GDP. So with a more positive picture on the inventory side and on the trade side, we do see growth bouncing back some. But having said that, if you look at our growth profile for the next year, we are looking for growth to be down around the 2% range. So 2 to 3%, and really not bouncing above 3% until the end of 2027. So this is a little bit below our trend of where we were in the 23 to 25 timeframe. So we see growth. We don't see the U.S. economy slipping into a recession, but we also don't see really strong growth, and not even the growth levels that we had in most of this decade so far, with the exception of really most of this decade, that period at the beginning of 22, and then for 25 we saw a little bit slower growth as well. All right, so why is it? Why do we see the economy growing slowly? We'll start with that, and then we'll get back to why we see it actually growing. So for one thing, consumer confidence has been sliding. So it bounced up last month, but it's been trending lower. And the consumer makes up the vast majority of the U.S. economy. So if consumers aren't confident, then they're not spending money. And if they're not spending money, companies don't need to produce goods, and they don't need to supply services. And so overall GDP starts to slow. Business leaders, this is the confidence index for business leaders. That you could read this two ways. You could look at it as sort of on a longer term trend going back to say 2020, 21. You can see that the trend has been down. It's obviously a lot of volatility here. We came down quite a bit more into 2022, but then it moved up through 24. But then in 25 we started to move back down again. I guess the good news, if you're looking at this graph, is that the CEO confidence has improved over the past year. It dropped dramatically at the beginning of last year, but then over the course of 2025, it has trended higher. So again, it's like our overall forecast, which is there's both good and bad news in this. We're at a relatively low level with our business confidence, business leaders' confidence, but we have been trending higher over the course of 2025. Yeah, the March numbers are probably all going to be pretty bad, depending on how long this war lasts, for both consumer confidence and for business confidence, because wars aren't great for confidence. So these numbers might tick down. And again, if this war it lasts for a long time, this could have more negative impacts on our forecasts and what we're forecasting now. But we don't think that it's going to be a long-lasting war. So we think that aside from a blip down in March, we'll probably continue to bounce back up on this business leader confidence, and probably reverse with the overall consumer confidence as well. And I know it's only 1 month, and I started this off saying we don't really read too much into 1 month, and we don't, but continue this upward trend a little bit in consumer confidence here as well. So some more news on the more pessimistic side is that if we look at payroll employment, it has been quite weak. We did get a blip up last month in January in the BLS data, but we're back down again this month. We had 5,000 in February, I should say. We had an increase of 5,000 jobs. The ADP numbers are a little bit higher, but still the trend in overall change in employment has been moving down. So not really great there. U.S. trade policy. So it remains uncertain. It had been trending better. We'd seen it trending down, and these things were starting to improve. And then with the Supreme Court ruling that said that the president doesn't have unlimited power to impose tariffs under IEEPA, that actually has led to significantly more trade policy uncertainty, because the president has imposed sweeping tariffs short term, and then has started investigations to impose tariffs that would last longer term, Section 301 tariffs that are more akin to the 232 tariffs, which we know about on the lumber side and the wood product side. So again, a lot more uncertainty over trade. So this number is good. This trade policy index is going to bounce back up to being less certain. So we combine all these things together. Really, some uncertainty in the trade situation. A lot of uncertainty around the war. We have declining employment and low confidence both on the business and the consumer side. So all of these factors are going to put downward pressure on our overall economic growth. So why do we think that we're actually not going to fall into a recession? It's a good question, actually. If we have, if inflation starts to tick up, which it hasn't, and if prices, so if oil starts to drive inflation higher, so far it hasn't done, but if the war lasts a long time and prices remain high, it's not actually the worst thing for the U.S. And I'm sorry, I'm taking a tangent here, but high oil prices. The U.S. is a major producer of oil, so high oil prices are actually good for the economy, because we produce, the value of what we're producing actually increases rather dramatically. We export a lot of the oil that we produce and natural gas to Europe. Our oil is light and sweet, and our refineries are made for more sour and heavy oil because of our imports of Middle Eastern and Venezuelan, historical imports of Middle Eastern and Venezuelan oil. So our refineries really take those heavier grades, but we're exporting a lot of those lighter grades to Asia and to Europe, and a lot of natural gas to Europe too. So that, those higher prices are certainly going to be good for the economy, for GDP growth. But on the other hand, the higher gasoline prices that come about because of this are going to be bad for consumer confidence. So sort of a mixed bag here. But again, the uncertainty around the war and lower consumer confidence, all these things putting downward pressure. So why no recession? Well, for one thing, if we just simply look at the this, I guess I would say your smartest economists in the country, the ones who work at the Fed, what they're seeing in terms of their recession indicator, they're showing it's actually an 18.8% chance of recession within the next year. So the Fed's does not expect a recession at this point in time. One of the main indicators that we look at and we really like is the yield curve. So your yield curve is simply your long rates minus your short rates. And the reason this is important is banks borrow money short and they lend money long. So if the yield curve is what's called inverted, so that the short rates are higher than the long rates, then it's very expensive for banks to borrow and lend. And so they tend to slow down their lending. They're much more picky on who they lend to. And so we see with that tighter credit, we see slower economic growth. When the yield curve goes normal and it's positive, then the long rates are higher than the short rates and banks are making money, and so they tend to be more willing to lend money. So the fact that we have a normal yield curve at this point in time is a positive for the overall economy. So this is what this graph here shows is your short-term interest rates, and this sort of a predictor of where the Fed is going to be going with their rates. The green area is a neutral rate. The blue line is your 3-month T-bill, and your red line is your 3-month T-bill minus your 1-year expected rate of inflation. So that's what the Fed's looking at, and they're trying to, if they're looking for contractionary policy, they're gonna push that red line above the green area. If they're looking for expansionary policy, they're going to try to drive that red line below the green area. And then if they want to be neutral, they'll be right in that green area, which is actually where they are today. So if we go back a month ago, 2 months ago, the Fed was actually in expansionary policy. And so we thought that it was, pretty unlikely that they'd be cutting interest rates because, for two reasons. One, their preferred measure of inflation still remains in the high 2% range, 2.7, 2.9% range. And they want to get it down to the low 2s, so 2.2, 2.3, somewhere around there. So with expansionary monetary policy and what they would consider to be still high inflation, we were not expecting significant rate cuts this year, but we have moved up to the upper range of the neutral zone. So we still don't think the Fed's going to be cutting rates because in the near term, because inflation remains elevated, and we still haven't seen significant increases in unemployment, even though it has moved up. So the Fed does tend to be more focused on that inflation component. And while we're still in the neutral area, it's increased the likelihood that they'll be lowering rates later this year, but I don't, and also increase the likelihood that they're going to increase them near term, but because it's neutral, we don't actually expect them to do that. Some other reasons for optimism on the U.S. economy, or at least to think that some drivers of why we don't think we're going to see an actual recession, is that real wages have been growing steadily. So, the long-term average is a little over 0.5% growth in real wages, and the latest reading was a little over 1%. And the trend has been going higher over the past several months. So our wages, even if we take into account inflation, our wages are going up. In addition, we do expect to see larger tax refunds this year than we've seen in the past. So this just shows you what the average annual tax refunds were over the past decade plus. And you can see last year folks got about $3,200 back. This year they're going to be getting about $3,700 back. So $500-$600 increase, about $550 increase in their tax returns. And we tend to, consumers tend to spend money when they get it. This is where an extended war will be negative for the overall U.S. economy, in that if we do have an extended war and gas prices remain elevated, a big chunk of this tax refund could get eaten up by higher gas prices. In addition to that, we could see consumers spending more conservatively, despite the fact that they have this extra money because of uncertainty around the economy. And this is a graph that I actually really like. I show this graph every time. This just shows you your that household debt service as a percent of disposable income. So this tells us the household's ability to withstand economic shocks. So things like job loss, things like rapid increase in prices because of an oil shock, that sort of thing. What it's showing us is the percentage of our income that goes to servicing our debt. So that goes to paying off our credit card bills, just the debt portion of it, not the principal. And you can see that while it's not at record lows, it is still at very low levels. It's been trending down since the Great Recession, and we did have these two blips that went extremely low that were a result of one, government transfers during COVID, and then two, the extremely low interest rates that we had during COVID. So this is now all gone up as those interest rates have risen, but we've actually stabilized. And with interest rates starting to come down, consumers can actually take on more debt and still have this number coming down. So still have that percentage coming down. So we have quite a bit of cushion to spend money and to dip into our credit if we need to in order to maintain spending. So when we put all these things together, the negatives in terms of business and consumer confidence, in terms of uncertainty surrounding the war and trade policy, and on the negative side, labor markets being decently weak. So those are all negatives, and then we counter those with the positives of the neutral monetary policy, and the strong household balance sheets, and then also the normalization of the yield curve. All of these factors lead us to think that we are going to not see the economy slip into a recession, but we are going to see slow growth. So that's on the overall economy side. Slow growth over the next year, potentially even 2 years. A little bit faster growth in 27, but still decently slow. How about on the home building side? Well, things are not as, I don't know, things aren't rosy on the overall economy side either. I was gonna say they're not so rosy on the home building side, but I guess it's a little bit worse on the home building side. So we do expect a little bit of growth in the overall economy, whereas we see residential construction markets being flat if we're looking at new residential construction markets, and actually coming off if we're looking at R&R markets. So why is that? Well, home builder confidence, it did bounce up last month, or I guess it's this month, it's a March reading, is up a little bit, but it's still not great. So home builder confidence is really low, and I'm going to show you a bunch of slides talking all about the indicators that should drive home building. But at the end of the day, if home builders are not confident, then they're not going to be building homes. And so we've seen this, across the board. If you follow any of the public statements or when the C-level folks get out and do their presentations from the home builder side, we see that most of them are expecting weaker demand in 2026. So I should say continued weak demand in 2026. So really not positive from that perspective. The single biggest concern for housing markets is the fact that it's currently unaffordable to buy a home in the US for your average household. So the red line here shows your median income, and the green line shows the income that's required to be able to afford a median priced home and qualify for a loan to get a qualified mortgage. And that just means that your annual cost of home ownership can't exceed 30% of your annual income. So what's the mortgage you need to be able to buy a median priced home today? You need $120,000, and the median income is $85,000. So folks are about, folks are about 35,000 under in terms of their income relative to what's needed. That's the bad news. The good news is this is changing. So for one thing, I guess this slide shows what's causing it. For the most part, it's this high home prices. So home prices have started to come off some, but they are near record levels. If we're what's changing going forward, we have seen in the last quarter, these home prices have started to come off, and they will continue to come off. For one thing, builders are building smaller homes. Right now, homes are about 12% below their peak. In addition, they're doing other things to get the cost of home building down, the cost of their homes down. So they're putting homes on smaller lots. They're putting in less expensive features and amenities. They're doing lower quality fixtures and appliances. They're doing what they can in order to bring the home prices down. And this data is a little bit old. This is from the middle of 2025. And so you would see even greater declines in here. But you can see, especially in the areas where folks are building a lot of homes in the West and down across the South, we're seeing pretty rapid declines in home prices. And that we do expect to continue because of what builders are doing and because of that lack of demand. So home prices have started to fall. So if we're looking at components of affordability, it's income, home prices, and interest rates. And as I talked about earlier, incomes have been growing decently, growing at a 1.1% rate. We do expect the economy to continue to grow. So in real terms, so we do expect incomes to continue to grow. We do expect home prices to fall. They've been falling, and we expect them to continue to fall. So two of those components on the of affordability are moving in the right direction. Mortgage rates are the third component of affordability, and I put the question mark in there, but we had for quite some time been seeing mortgage rates moving lower, and so that was really good news. We were starting to see that trend down. So all three components of affordability were certainly improving. With the war, we've seen a bounce back in mortgage rates. So mortgage rates were below 6% for a week, but then they pop back up to above 6%. So, not moving in the right direction. So where do we see them going forward? Well, for one thing, this bounce up in interest rates is related to the war and uncertainty over the war, and I'll get to that in a second. The other driver of mortgage rates is the 10-year Treasury yield. You can see that they move closely together. So it's a combination of the actual rates and then the spread between the mortgage rate and the Treasury yield. So what drives the 10-year Treasury yield is the market's perception of the U.S. economy and inflation longer term. And now that's driven by consumer confidence and GDP growth and employment, and then also what the Fed's doing on the short term. And actually, when the Fed lower rates, oftentimes that increases inflation expectations, so can tend to drive the 10-year Treasury yield up. So unless you're lowering interest rates because the economy is slowing, in which case the slowing economy overpowers the lower interest rates in terms of its impact on the market, and so we can actually see the 10-year Treasury yield come down. But the spread is something that is driven by lenders' perception of risk. And when mortgage rates are when interest rates are moving up, perception of risk increases. In particular, because typically when somebody is taking out a mortgage, they're locking in a rate 60 days in advance. And so, if you're a bank, if you know the Treasury yields are moving up, and you know that in 60 days from now it's highly likely that they're going to be higher than they're at today, you're going to want to build in a little bit of a cushion. In addition, when mortgage rates are going up, default rates tend to increase, and so they want to increase that risk premium. When the yields are coming down, when the Treasury yields are coming down, the banks can decrease that spread just a little bit because the risk factor has come down, and also because in lending in 60 days out, they know that in 60 days from now, or perceive that in 60 days from now, the rate at which they'll be able to borrow or will have decreased. So what we've seen is that we've seen the spread widen as rates were going up here in 21, 22, and they've actually narrowed quite a bit. So the historical spread is about 1.7%. 1.78%. Right now, we're right around that level, a little bit over that. So there is a little bit of room for the spread to come down some. but not a lot of room if we're going back to the historical averages. We don't have to go back to the historical average. We can go below that, but a lot of the decline that we've seen so far has been a contraction in this spread. So for interest rates to really move significantly lower going forward, we're probably going to need to see the 10-year Treasury yield go down. We don't see that as being, we don't see a sharp decline in the 10-year Treasury yield for a number of reasons. One, inflation remains stubbornly high, and two, the federal government is running massive deficits and have massive deficits planned well into the future. And so with such large deficits, it's unlikely that we're going to see these rates come off much. And then the economy, we are expecting that to grow 2-3%. So we're going to need to see elevated treasury yields because we will see elevated treasury yields because of that. So, so the bottom line on this is the idea that we're going to see mortgage rates decline to say 5%, which would be needed likely to get housing starts back up to the 1.6 to 1.65 range. The likelihood of this going to 1% in the near term is pretty low because we don't have a lot of room for contraction on the spread, and it's unlikely that we're going to see a sharp decline in the 10-year Treasury yields. So, I mean, you'll see when I get to the housing starts forecast that we don't see us going back to 1.65 in the next couple of years, and we see us staying more in the 1.35 to 1.45 range, and that's because we see these mortgage rates staying in the 5.5 to 6, and really in the 5.6, 5.7 to 6.2 range, somewhere in there. And at those levels, housing starts, with current affordability conditions, housing starts are likely to stay in the 1.35 to 1.45 range. So what about this recent just blip up? We don't think that, so this is related, this latest blip up was related to the war in Iran. And we don't think that that is going to be a long-lived war. If we actually look at the futures market, they agree. This shows you the future Brent crude futures, and you can see it's coming off. And granted, this is a long time frame, but even over the course of this year, we see the futures market sees this war ending fairly quickly, and because of that, they see oil prices coming down fairly quickly. So if that happens, which is the expectation of the markets, but it's also a lot of what you're hearing in terms of the Israeli government is saying that this will be that they have 3 weeks worth of target, and we have President Trump talking about how we've already won, and we've already we don't have as many targets to hit anymore. So I think that a lot of this is pointing towards a shorter rather than a longer war, and that's our base forecast for now. So in terms of that sort of short term, this blip up, we do see that starting to reverting back to this downward trend once this war is over, which we would expect to be in the shorter rather than the longer time frame. And then why do we expect to see the rates continuing to trend lower? Well, for one thing, there's not a lot of inflationary pressure from a labor force perspective. What this graph shows is the ratio of demand to supply in the labor force, and that green line is neutral. So anything above the green line means a tight labor market, and anything below it means a weak labor market. So we're not in an extremely weak labor market, not weak enough to really hamper GDP growth and cause a recession. But on the other hand, labor markets are weak enough to really ease some of the inflationary pressures of workers demanding higher wages. If we look at the bond markets, they don't expect inflation either. I mean, the bond markets have been saying that expected inflation over the next 5 years is right around 2%. It's right around the Fed's target. It's not high at all. So we haven't seen a big bounce up in bond market investors' inflation expectations. So bottom line on this is that we think that if we're looking at affordability, it's going to improve because incomes are going to go up, home prices are coming down, and interest rates are going to come down slowly. But having said that, there's still a $35,000 spread between the qualified income to buy a home and the income that folks are making. So we still are a long way away from being in balance in terms of the at the affordability of the housing market. So what does that mean for our housing starts forecast? We would actually have a little bit of growth this year in 2026. We have it flat. We would have a little bit of growth if it weren't for the weak builder confidence. So the data indicates with improvement in affordability, we probably should have a bit of an increase in housing starts to sort of stay in the 135 to 1.4 range, as opposed to staying much closer to 135. But because builder confidence is so low, we think that they're probably going to hold back a little bit on their building and keep housing starts right around 136. I will say that prior to February 28th, when Brennan and I were talking, and we were saying that our forecast is probably too low, we probably need to raise this because the mortgage rates were trending down a little bit faster. And so we were actually leaning towards, we thought the risk was on the upside, but now that we are in a conflict and we have interest rates increasing because of that, we're probably not going to change our forecast for March at this point in time. We do see a bit more of a bounce back in 27 as we believe the war will be over. The interest rates will continue to trend down. We would expect those mortgage rates to be in the 5.5 to 6% range, low enough to cause housing starts to jump up to that 1.4 to 1.45 level. So again, not great. This is still going to be, lumber markets are still going to be, and panel markets are still going to be driven by the supply side, but at least we'll have more consistent demand to hold prices a little bit higher and to hold markets a little bit higher. So I do like to talk a little bit about some of the trends underlying these markets, and I guess let me just pop back here for a second. And the reason is because if we look back historically, and I don't have a lot of, well, I got 27 years or 25 years of historical data, but if I went back further than this, what you would see is that during a typical recession, interest rates would go up about 2%, and housing starts would drop by about 500,000 or 600,000 units. They dropped to around 1 million units. So this is not a typical recession. Here, we all know, everyone who's been around, lived through the Great Recession knows this was not typical. But still, we had housing starts drop well below 1 million units. But if you go back to the recessions in the early 90s, in the early 70s, in the early 80s, all those timeframes, you'd see about a 2% rise in interest rates would lead to about a 500,000 to 600,000 unit decline in housing starts. Well, from the trough in interest rates to their peak, we saw more than double that. We saw about a 4 percentage point increase, so 400 basis point increase in interest rates, and housing starts dropped by about 250,000 units. So we saw twice the increase in interest rates and half the decline in housing starts. So why is that? I think it's because of the tremendous pent-up demand we have for housing and the really strong demographic tailwinds. So if you're looking for a positive to take out of this presentation, it would be that even though economic conditions are really terrible for housing starts have really not fallen that much relative to what we would typically see historically, given just how bad the unprecedented nature of the spread between what's affordable and what folks actually make. So just real quick on this, the green line is your underlying demand. It's what we need to produce on average to house our growing population. The red line is what we've been producing. You can see that historically we kind of trend around that. Then we overproduced for a decade from the mid 90s to the mid 2000s. Then we underproduced dramatically in the latter half of the 2000s, such that by 2011, all of this overbuild had already been sucked up. And this pretty much entire period of the past 15 years, we've been underbuilding. So what is that? That's young folks living at home longer. It's young folks taking on additional roommates. It's parents living with their adult children. It's unrelated households living together. So it's all of those things. And so the folks are not able to separate out. Initially, they weren't able to because the housing units just didn't exist. And now they're not able to do it because of a lack of affordability. But what this is telling us is that as affordability improves, there's a lot of demand out there, and people are going to be buying up homes as they can afford it. As their incomes increase, if home prices come down, if interest rates come down, you'll see this as real solid support on the bottom end of the market. The other piece of this is your population and your demographics, and these red bars show you your population by age currently. I guess 2024, and then you can see that we have a big bulge of population here. In fact, the most folks we have are in their early 30s, which are your prime home buying years. The reason I put the purple line in here is because there are a lot of analysts out there saying that this decade is going to be okay, but next decade is going to be really bad for housing demand. And I would argue, I mean, this is in 2035, we have a huge spike in folks in their late 20s and early 30s, and even out into their 40s here. So this is a big group of people who are still going to be in their prime home buying and home move up years. I would be more worried about what's going to happen in the 2040 to 2050 period. So unless we increase immigration, we are going to have well, what's probably going to happen is we're just going to, these folks are going to finally be able to separate out at the rate that their grandparents did, I guess, at that point, because we're never going to make up this pent up demand. This is about 5 million units of pent up demand. So we're not going to make that up by building. It's going to have to come through fewer folks. So in any case, for the next decade or so, we're still in good shape. From an R&R perspective, we do expect to see R&R markets weaken. If you follow the investor calls of the big boxes, they talk about how demand is weak. We had an extended period of spending more than trend, so we do see R&R activity coming back towards trend, but we don't see it dropping below trend for a number of reasons. One, our housing stock is old. Because it's old, it's also small. About 60% of our homes are less than 2,000 square feet. And then even if we take into account the amount that the increase in size of homes through additions and alterations, your current median existing home is still about 20% smaller than your current new home. So folks do want to if they have an older home, they do want to make that home bigger. So another issue is that historically we've seen a lot of R&R activity occurred right around when people sold and bought homes. You would sell a home. Before you sold a home, you'd fix it up some. After you bought a home, you would add on to it. You'd fix up some of the things that the previous owner hadn't done. You change it to make it more like your pace. But lately, that's not been the case because of the rapid change in mortgage rates. So mortgage rates got so low in the early part of this decade that a significant number of folks locked in extremely low mortgages. Then mortgage rates popped up, and now these folks who had bought homes for the first time, in 2019, 20, 21, 22, that time frame, and got significantly quite low interest rates, they're looking at significantly higher interest rates if they want to move up. So these folks are in what we call rate lock, in that, if you're looking at half of mortgagees right now have mortgages that are at least 2% below your current level. So if these folks decide they want to move up, they're going to have to take on a 2% plus higher mortgage. So they're being locked into their home. So we're seeing these folks are fixing up, they're adding on, they're making improvements as opposed to moving up. In order to do that, you need home equity. Luckily, home equity is at record levels or near record levels, and that home equity is very well dispersed. So it's not all, that home equity is not all tied into just the top end. About 85% of US mortgages have at least 30% equity in their home, so folks can tap into that. So when we put this all together and look at what this means for consumption, what we expect to see very little growth in consumption, about 200 million board feet in 26. The decline in R&R expenditures. We have limited growth in industrial production. Limited growth in non-res markets. We do see a bit of growth in Canada, and then flat new residential construction markets. But somewhat offsetting that is actually a shift towards continued shift towards more single-family construction relative to multifamily construction. It's something that's been going on for a while now. That will reverse in 27, 28, but at least for the near term, we're building more single-family homes. So in any case, a little bit of positive there on the single family side, but generally we're looking for very little growth in 2026, like I said, about 200 million board feet. And then it's not till 27 that we see a bit more growth, looking at about $1 billion to $1.5 billion increase in consumption. So that's the main driver of demand on North American mills. The other component is exports. We do see some growth in exports, in particular from Canada and from the U.S. South. So the driver behind the growth in Canadian offshore exports is the very high duties and tariffs in the U.S. and looking for alternative markets. In the South, it's that low cost of their logs and the low production costs that they have, looking for alternative markets. And then also the shift of ownership in the South away from U.S. ownership and towards Canadian ownership, and the Canadians have more. They tend to be more in, especially the Western Canadians tend to be more in the export markets. So to the extent that they're the ones who own the mills in the South, they do have those markets, and they do have a low cost resource there. The problem, and why we don't see this going higher, is because of the main market for exports has always been China, and Chinese consumption is very weak and is likely to remain weak going forward. We've seen a big drop in housing construction there. I think we've all heard about the ghost cities, and so they just simply don't need to build a lot more homes. If you look at some of the other markets that are out there, you have India, you have the Middle East and North Africa, but the Middle East and North Africa is a big market for Europe. Russia is going into the Middle East and North Africa because of, well, not currently, but prior to the end of February, they were trying to sell more into there because of restrictions on shipping into the West. And they were also taking market share in China as well. So tough international competition in a generally weak market is going to prevent much more growth on the export side. Turning to supply, we do think that there's going to be a decline in imports. This will be mainly driven by a decline in imports of European wood. That's the main driver behind our offshore imports into the U.S. But we don't expect them to collapse. I know that there are a number of analysts out there that are saying things like the European shipments to the U.S. are going to go to zero, or that the U.S. is going to become a net exporter. I've heard both of those things. I don't think either of those things are going to happen. We do think that we're going to see a decline. What these folks are looking at a lot of times are these next two slides, which are one, there's a spruce bark beetle epidemic, which killed off similar amounts of spruce to the lodgepole pine epidemic in British Columbia, not quite as much, but still lost a lot of volume of timber. So I think some of the folks are thinking, well, that's going to be less wood available for export. Similar, if we're looking at land use policy and land use policy changes, a lot of those policies are aimed at keeping trees in the forest instead of harvesting them. And so what we would expect from that is less timber to be available as well. But the reality of the situation in Europe is that they've seen a pretty large decline in their domestic consumption, and that's unlikely to bounce back in the short term. And because of that, they do, even with a decline in log availability, they've had a larger decline in consumption. And then also in terms of their main export markets, one of the main export markets is China. China has seen really weak consumption. You've also seen Russia grab market share there. Other markets, if you're looking, I don't think we want to talk about this, but things like Australia, which has been a destination for European wood, they're seeing more and more substitution of solid sawn for LVL sawn produced in China and sawn into dimension sizes for building. So lots of competition there. That's gonna keep Europe shipping wood into the North American markets. I know I'm getting towards. I know I'm beyond my time, but I will wrap up here pretty quickly. So the other component on the supply side, so declining imports. The other component on the supply side is that we've seen a pretty massive decline in capacity. So this net capacity expansions from 23 to 25 includes, this net capacity expansions is both expansions, new mills, and closures. And you can see that the closures actually surpass the expansions and new mills to the tune of a loss of about 1 billion board feet. And then if we look at sort of what's going on here, that most of those, actually almost all of the closures have been in Canada. In net terms, definitely. So between BC and east of the Rockies, you're looking at about 2.5 billion board feet, where we've actually seen expansion of about 1.5 billion board feet in the US South. So this is playing out in the pricing dynamics that we're seeing in the marketplace of those very weak southern pine prices. I know right now they popped up because of just typical seasonal buying patterns and treaters buying wood. And then also there have been a number of closures in the South as well, short-term supply disruptions. But generally speaking, over the course of last year, we saw significantly lower, well, even really the past couple of years, we've seen significantly lower southern pine prices relative to Western SPF prices. And just to put that into perspective, the long-term average spread was for FOB mill prices was a 13% discount for Western SPF to southern pine. We're now running at close to a 30% premium for Western SPF. So that's a 40% swing in the relative pricing of the products. And that's because of this relative swing in capacity, the more closures of SPF and more expansion in the US South. Here's our current duty rates. I think early April, we should be getting the results of AR7. We do expect to see them come down some. These very high anti-dumping rates for CAN4 likely won't be continued through AR7. They closed a few mills, and so they had high costs because of that. We would potentially expect to see an increase in the countervailing duty rates, especially in AR8, based on actions that have taken place in 2025. So, all in all, we're looking at probably about a 10% decline in the all others rate, so dropping to probably 35%. I will just point out that President Trump left open increasing the Section 232 tariffs. So if we see a 10% decline in the duties, we could see the tariff rate actually increase by 10% to maintain that sort of 45% duty and tariff combination on wood coming into the U.S. But for now, our forecast assumes it drops to the 35% range. So just talking a little bit about where prices are and what we expect for the rest of this year. Prices have moved up in the first part of this year. This is a supply side phenomena. It's not being driven by demand. Simply the closures that took place last year in the beginning part of this year have driven prices up. That combined with some inventory buying. The reality of the situation is, though, that mills are now making money, especially in the U.S., and so production is going to start to increase, and production can quickly outstrip demand at these weak levels. So we do expect to see in the short term some downward pressure on prices. If you're looking across the SPF world and across Canada, this is just for wood shipped into the U.S. So I know it looks pretty bad, and it is pretty bad actually. It's not profitable to send into the U.S., but about 40% of their wood is either consumed domestically or shipped overseas, and so that is operating at a significant profit. So mills aren't losing as much money as it looks like here. So we'll continue to see production from the Canadian side as well. So what does this mean for pricing? Well, in the near term, we do, with profits, with prices now above cost, we do see prices coming down a little bit in the near term, but bouncing back up again over the summer. And basically over the course of the year, we're looking for prices to be, not significantly higher than they were in 2025, looking at maybe 3-4% increase in prices for the year relative to 2025. And then prices a little bit higher again in 2027. So what's driving this? The supply side closures that we saw in 25 are the closures that we saw in 25 are going to have brought supply back in line with demand. So anytime we get some increases in demand without that capacity online now, is going to cause prices to move up. As that happens, mills will make money. They'll produce more lumber. That will cause prices to come back down again because we don't expect to see sustained growth in consumption. I do want to point out that All these prices come from FEA's new report, Price Pulse. They're not. I know in the past we've used other reporting services, but we are now using our own service. So if you guys want to find out more about this, if you're looking for a competitor, to Random Lengths, then just reach out and we can provide you with an alternative to that. We have an extensive product that covers all of the products. So just real quick, I'll talk a little bit about the pulp and paper markets. This isn't going to come as a surprise to anybody, but the decline in demand for paper and the increase in consumption of packaging, those trends we do expect to continue. This combined with some massive expansion in pulp capacity in the southern hemisphere has led to significant closures across North America. And so on a going forward, which has decreased production in North America. So on a going forward basis, we do expect to see pulp production continue to trend lower, although not significantly from where we're at in 2025. So with that, I will open it up to questions. I know we're close to the end of the hour, but I think we started a couple minutes late too.
Yeah, thanks, Paul, for all that information. We do have a couple of questions. So the first one, I think it was when you were talking about demographic tailwinds. It's asking, in the period between 2008 through 2022, who was purchasing the overproduction of units?
We weren't overproducing. We were dramatically underproducing. So sorry, let me so 2008 to 2000, what time frame?
2008 to 2022.
Perfect. So this is what we should have been producing, and this is what we were producing. So we were dramatically underproducing the market. And so what that led to was higher prices and folks not being able to separate out. So it really, I shouldn't even say that. It's really the other way around. Because of banks lending, the tightness of their lending standards, we were seeing a really weak demand. We were seeing young folks, and then also subsequently the rise in home prices, especially in the more recent times. We were seeing young folks deciding that they couldn't separate out and form separate households. We were seeing adults living with unrelated households. We were seeing parents move in with their adult children. All of things happening because of a lack of affordability and inability to get loans. And so we were actually, because of that, the demand was really, really weak. And so we didn't actually need to produce those homes. But all those folks still exist. And the way this manifests itself is that if you look historically, we've had about a little under 2 adults per household on average. But if you look at it today, we're well over 2 adults per household. So not 2.5, but we're in the 2.1, 2.2 adults per household range. So we've seen a big shift in our population towards more adults per household, whereas historically that hasn't been the case. And that's because, it's I guess the causation is the fact that we've seen that shift was caused by a lack of affordability, and that caused builders to build too few homes, and so yeah, that's where we're at today.
Okay, and then the next question: what do you think will take the place of low-grade wood that has gone to pulp mills in the past?
That's a good question. And the market for the market for residuals and low-grade lumber is tough. And I mean, obviously it's a big issue going forward. So there's a lot of research into things like biofuels, wood fiber as insulation, wood fiber for pellets. So we don't, in terms of the lower quality logs, I don't know where. I guess that's not my area of expertise, so I don't really know where those lower quality logs will go. It's probably a question for Rocky, but I'm not sure if he has an answer for that either.
And actually, our other question was also along similar lines. asking if you've seen any significant amount of low value trees being used for fuel or biochar in New York or other places.
If I've seen a significant increase in them being used for that.
Yes.
Yeah. So we have not seen a significant increase, but certainly it is a market that it's certainly a market that has some potential going forward. I know that there's been a lot of research into that. We've been involved in some projects as well for folks who are looking to use biochar. So I think we're still at the early stages there. Um, so I think it's still early. So I wouldn't expect to see a big increase in demand over the next 2 to 3 years from that.
Okay, great. Thank you, Paul. Those are all the questions we have. And just to wrap things up, a reminder that this recording is available at farmcrediteast.com. And also, if you're looking for credit information, please email chris.lawton@farmcrediteast.com. Thank you again, Paul. And any last words for the
No,
presentation?
yeah, no, thank you guys all for listening. I appreciate it. I appreciate you taking the time. And I was trying to pull my, I don't know if you can still see my,
Yes, we can.
okay, good. Yeah, I was trying to pull up. So if you have any questions, just lost again. Yeah, feel free to reach out to me. If you, that QR code actually creates an email that you can send to me, and I can send you the presentation directly, or my contact information is there as well if you want to just reach out to me the old fashioned way. But thank you all for taking the time to listen. Appreciate it.
Sounds great. Thank you, Paul, and thank you everyone for joining us today. Have a great day.
You too. Bye-bye.